You have been lied to, not with malice, but with a quiet, pervasive certainty that has shaped every institution you have ever passed through. From your first day of school, you were rewarded for the crisp, correct answer. You were taught that the path to success was paved with precision, that the mastery of detail was the hallmark of intelligence. In university, you were handed textbooks filled with elegant equations that described the world with a beautiful, seductive accuracy. When you entered the professional world, you were given spreadsheets, software, and systems designed to measure, quantify, and optimize every conceivable variable down to the fourth decimal place. You have been psychologically conditioned over decades to believe a single, foundational truth: that the pursuit of precision is the pursuit of success. And this belief, this core tenet of your operating system, is a trap. It is the most dangerous cognitive prison for the ambitious mind, a gilded cage of analysis paralysis, an engine for generating catastrophic errors disguised as intellectual rigor. It is the cult of false precision, and it is the primary reason why so many brilliant people fail to achieve outcomes of any real magnitude. They become masters of the trivial, experts in the irrelevant. They become, in the words of the great philosopher Alfred North Whitehead, guilty of the fallacy of misplaced concreteness. They spend their lives sharpening a scalpel to perform surgery on a ghost. But what if there was another way? A different operating system entirely, a cognitive framework used by the world's most successful decision-maker, not to achieve greater precision, but to systematically destroy the need for it. A system built not on complex models, but on ruthless simplification. A mind that has generated hundreds of billions of dollars in wealth not by being more exact than everyone else, but by mastering the profound and deeply misunderstood art of being approximately right. This is the story of Warren Buffett's most foundational and least understood mental model. It is the hidden architecture behind his seemingly superhuman judgment. It is not a tool for finding the right answer. It is a weapon for making the right decision. This is a complete deconstruction of the Approximate Rightness Doctrine. And by the end of this journey, you will understand that the key to getting the big things right is to develop a profound and comfortable indifference to being precisely wrong. The story begins not in Omaha, Nebraska, but in the hallowed halls of academia and the gleaming towers of Wall Street. It begins with a hedge fund called Long-Term Capital Management, or LTCM. If you were to design a temple to the god of precision, LTCM would have been its Vatican. Founded in 1994, it was a dream team of intellectual firepower. On its board were Myron Scholes and Robert C. Merton, who would, in 1997, win the Nobel Memorial Prize in Economic Sciences for their work on the Black-Scholes model, an equation of breathtaking mathematical elegance used to price financial derivatives. The firm was packed to the rafters with PhDs in physics, mathematics, and computer science, the high priests of quantification. Their strategy was, in essence, to be the smartest guys in the room. They built the most complex, data-intensive computer models the financial world had ever seen. These models scoured the globe for tiny, fleeting mispricings between related securities, a government bond in Italy and its equivalent in Germany, for example. The discrepancies were microscopic, often fractions of a penny. To profit from such infinitesimal errors, LTCM had to employ staggering amounts of leverage. For every $1 of their own capital, they borrowed more than $25. They were picking up pennies in front of a steamroller, but their models told them, with pinpoint precision, that the steamroller would never arrive. Their spreadsheets were works of art, their algorithms a testament to human ingenuity. They were precisely, mathematically, and brilliantly certain. And in September of 1998, they were precisely, mathematically, and brilliantly wrong. A series of unforeseen global events, Russia defaulting on its debt, a crisis in Asia, caused the tiny market discrepancies they were exploiting to widen into chasms. The correlations their models had assumed were constant suddenly broke down. The steamroller had arrived. In a matter of weeks, long-term capital management lost $4.6 billion. vaporizing almost all of its capital and bringing the entire global financial system to the brink of collapse. It required a bailout orchestrated by the Federal Reserve itself to prevent a chain reaction of failures. The smartest guys in the room, the high priests of precision, had failed on a scale that was almost unimaginable. They had been precisely wrong. Their story is not an anomaly. It is the ultimate parable of the modern condition. We are drowning in data, yet starved for wisdom. Our capacity to measure has outstripped our capacity to understand. We have built systems of such complexity that we mistake their intricate workings for a true reflection of reality. This is the precision trap, and it has 3 psychological hooks that are almost impossible for the ambitious, intelligent individual to resist. The first hook is the illusion of control. A detailed spreadsheet with 50 variables, each calculated to 3 decimal places, feels like control. It feels like you have tamed uncertainty. You have wrestled the chaotic, unpredictable future into a grid of cells and formulas. It's a powerful psychological comfort. The act of measuring and modeling creates a feeling of mastery, even if the underlying model is completely detached from reality. When a manager asks for more data, they are often not seeking information. They are seeking the emotional comfort that comes from the process of gathering it. The second hook is ego and intellectual validation. In our society, intelligence is often equated with the ability to handle complexity. The person who can build the most intricate model, who can recite the most obscure data point, who can argue the finest nuance, is perceived as the smartest. Simplicity is mistaken for simple-mindedness. To say, "I don't know," or "this is too complicated for me," is seen as an admission of intellectual failure. Therefore, the ambitious are driven to engage with complexity, to prove their worth by wrestling with the most difficult problems, even if those problems are not the most important ones. The third hook is institutional inertia. Large organizations are machines built to mitigate blame. A decision based on a 100-page report filled with complex analysis is a safe decision, even if it's wrong. If it fails, the decision-maker can point to the mountain of data and say, "I did my due diligence." A decision based on a simple qualitative judgment, on a gut feeling, or a back-of-the-envelope calculation, is a risky decision, even if it's right. If it fails, the decision-maker has no paper trail to hide behind. This institutional imperative creates a powerful incentive for ever-increasing complexity, for more meetings, more reports, more data, all in the service of creating a defensible process, not necessarily a better outcome. These 3 hooks, the illusion of control, the validation of ego, and institutional inertia, create the bars of the precision trap. And inside this trap, the world's brightest minds spend their days optimizing the irrelevant, debating the unknowable, and building elegant models that describe a world that does not exist. They are all LTCM in miniature, waiting for their own personal Russian debt crisis. Now let us travel from the frantic, hyper-computerized trading floors of Greenwich, Connecticut, to a quiet office in Omaha, Nebraska. Here, there are no screens flashing with real-time data. There are no teams of quants building complex algorithms. There is a man sitting at a large wooden desk which has been in his family for decades. The desk is clear, save for a few books, an internal telephone, and perhaps the annual report of a company he is reading. This is the command center of Berkshire Hathaway. This is the habitat of Warren Buffett. And here, the cult of false precision has no power. Buffett's entire $90 billion fortune, the greatest investment track record in human history, was not built by being more precise than everyone else. It was built by installing a completely different and ruthlessly effective mental operating system. An operating system designed to bypass the precision trap entirely. He calls it, simply, staying within his circle of competence, but it is much deeper than that. It is a complete philosophy of knowledge, a cognitive framework for making monumental decisions under conditions of profound uncertainty. We call it the Approximate Rightness Doctrine. And it is built on 3 foundational pillars, 3 cognitive protocols that, when combined, create a state of clarity, conviction, and decisiveness that is almost superhuman. The first pillar is the Great Filter, a system for ruthlessly simplifying reality. The second pillar is the zone of indifference, a method for weaponizing imprecision in the act of valuation. And the third pillar is the decisiveness engine, a psychological mechanism for acting with colossal force when an opportunity becomes overwhelmingly obvious. To truly understand this operating system, we must deconstruct each of these pillars, not as abstract theories, but as the lived, practiced, and perfected tools of the master. We begin with the first, and perhaps most important, pillar, the great filter. It is the gateway to the entire system, the protocol that makes everything else possible. It is Buffett's defense against the siren song of complexity, his cognitive kill switch for the noise that paralyzes the rest of the world, and it is founded on one of the most powerful and most terrifying ideas in all of business, the power of I don't know. Pillar 1, the great filter. At the core of the modern business world is an unspoken assumption that every problem is solvable, every question is answerable, and every asset is valuable if only you apply enough intellectual horsepower. The job of the smart person, the analyst, the consultant, the executive, is to have an opinion on everything. To not have an opinion is to be unprepared, to be lazy, to be unintelligent. This pressure creates a world of forced competence, where brilliant minds are incentivized to generate complex answers to questions they don't truly understand. Buffett's first pillar, the great filter, is a complete and total inversion of this reality. His starting point is not, how can I solve this, but is this even worth solving? He has famously described his approach to investment opportunities by visualizing 3 trays on his desk: in, out, and too hard. The overwhelming majority of ideas that cross his desk, 99% of them, go directly into the too hard tray without a moment's hesitation. This is not an act of analysis, it is an act of cognitive triage. He is not trying to understand the world. He is trying to identify the tiny sliver of the world that is, for him, easily understandable. This concept is often conflated with his circle of competence, but the too hard pile is the active, operational tool that defines the circle. It is the bouncer at the door of his mind, and this bouncer is brutally, ruthlessly effective. What lands a company in the too hard pile? Not necessarily a bad business, not necessarily an overvalued one. The primary criterion is a lack of simplicity and predictability. If he cannot, in a few minutes, understand the fundamental economics of the business, how it makes money, why it has a competitive advantage, and what it will likely be doing in 10 or 20 years, it goes into the pile. Technology companies with rapidly changing product cycles, too hard. Pharmaceutical companies reliant on patent cliffs and the outcomes of clinical trials, too hard. Airlines with vicious competition, high fixed costs, and vulnerability to fuel prices, for decades, too hard. Retailers whose fashion tastes could change on a whim, too hard. This is not a judgment on the ultimate success or failure of these businesses. It is a judgment on his ability to predict their success or failure with a high degree of confidence. He is not looking for opportunities to be brilliant. He is looking for opportunities so simple that they don't require brilliance. He is searching for the 1-foot hurdles he can step over, not the 7-foot bars he has to jump over. Let us make this concrete with a case study that perfectly illustrates the power of the great filter. Consider the year 1972. The world was complex. The Vietnam War was raging. The Nifty 50 stocks were soaring on Wall Street, a group of beloved growth companies like Xerox and Polaroid that were considered so good you could buy them at any price. Technology was advancing. The world of finance was becoming ever more quantitative. And in this environment, Warren Buffett, through Berkshire Hathaway, made one of his most important acquisitions. It was not a technology company. It was not a complex conglomerate. It was See's Candies, a family-owned, California-based chocolate company. To the high priests of precision on Wall Street, this was an absurdly simple, even trivial, business. It was a relic of a bygone era, Where was the growth? Where was the innovation? Where was the leverage? But for Buffett, See's Candies was the perfect specimen to pass through the great filter. He didn't need a 100-page report or a complex computer model to understand it. He could grasp its essence in minutes. First, the product was simple and timeless. People had been eating chocolate for centuries. The desire for a high-quality giftable confection was not going to be disrupted by a new technology. He could confidently predict that people in California would still be buying See's Candies in 10, 20, even 50 years. The business was predictable. Second, the competitive advantage was not based on a patent or a complex process, but on something far more durable: psychology. See's had been a California institution for over 50 years. Generations of families had grown up with it. The brand was lodged in their minds as synonymous with quality, nostalgia, and special occasions like Christmas and Valentine's Day. This share of mind was a powerful moat. A customer looking for a gift for their mother was not going to risk buying a cheaper, unknown brand. The perceived quality and the emotional connection to the brand gave See's immense pricing power. They could raise their prices year after year, and customers would barely notice, because the price of a box of chocolates was a tiny fraction of the social value of giving a trusted, high-quality gift. Buffett understood this intuitively. He didn't need a market research survey to tell him. He saw a business whose key asset was not its factories or its inventory, but the happy thoughts it occupied in millions of brains. This was a qualitative, not a quantitative, insight. Third, the economics were beautifully simple. The business required very little capital to grow. It generated cash, and it didn't need to be constantly reinvested in expensive research and development or new machinery. It was a cash machine. Notice what Buffett did not need to know. He did not need to know the precise price of cocoa beans next quarter. He did not need to forecast GDP growth in California to 3 decimal places. He did not need a complex model of consumer spending habits. He filtered out all of that noise. He focused on a handful of simple, powerful, and enduring variables: a timeless product, a powerful brand built on psychology, and the resulting pricing power. He was being approximately right. He concluded that this was a wonderful business, and then he and his partner, Charlie Munger, turned to the question of price. They paid $25 million for See's. At the time, Munger thought it was too high. Their own analysis, a more conventional one based on book value and earnings, suggested a lower price. But Buffett had the more profound insight. He understood that the intangible asset, the brand in the minds of customers, was worth far more than the tangible assets on the balance sheet. That $25 million investment has since generated over $2 billion in cash for Berkshire Hathaway, cash that was then used to buy other wonderful businesses. It became the prototype, the cognitive model, for dozens of future investments. The great filter had worked perfectly. It had screened out a world of complexity and identified a pocket of beautiful, profitable simplicity. This process is not intellectually easy. In fact, it is psychologically brutal. It requires the systematic suppression of ego. The ego wants to show off, to tackle the hard problem, to have an opinion on the hot tech stock everyone is talking about. To say too hard over and over again feels like an admission of inadequacy. But for Buffett, it is the highest form of intellectual honesty. It is the recognition that the human mind has severe limitations, and the only path to wisdom is to operate well within those limits. The cognitive bias that the great filter is designed to annihilate is what we can call complexity bias. This is the subconscious tendency to equate the complex with the sophisticated and the simple with the simplistic. We assume a complex strategy must be better than a simple one. We assume a thick report is more insightful than a short memo. We assume a person using big words knows more than a person using small words. The great filter is a weapon against this bias. It is a commitment to the idea that in investing, and in most of life, the winning strategy is not to find the right answer to a complex question, but to find a simple question that has an obvious answer. It is the art of weaponizing ignorance, of making "I don't know" the most powerful phrase in your cognitive toolkit. It is the first and most crucial step in achieving approximate rightness. Because once you have filtered the vast, chaotic universe down to a small number of simple, predictable situations, the next step becomes infinitely easier. You no longer have to be a genius at valuation, you just have to be sensible. And that brings us to the second pillar of the doctrine, the zone of indifference. Pillar 2, the zone of indifference. If the great filter is about simplifying the nature of the problem, the zone of indifference is about simplifying the nature of the answer. Having filtered out the vast majority of businesses as being too complex, Buffett is left with a small handful of companies he understands deeply. Now, he must face the question of price. What is it worth? Here again, the cult of false precision rears its head. On Wall Street, valuation is treated as a science. Analysts build elaborate discounted cash flow, or DCF models. They project a company's earnings out for 10 years, assigning specific growth rates for each year. They calculate a terminal value based on a perpetual growth assumption. They discount these future cash flows back to the present using a precise cost of capital, often calculated using the capital asset pricing model, which itself relies on variables like beta measured to several decimal points. The result is a single number, a price target, presented with an air of scientific authority. Our analysis shows that the intrinsic value of Company X is $154.27. Buffett views this entire exercise as an absurdity. He has said, "It's better to be approximately right than precisely wrong." And nowhere is that philosophy more apparent than in his approach to valuation. He understands that a DCF is not a calculator for spitting out a precise answer. It is a cognitive tool for understanding a business. The goal is not to get the number right. The goal is to understand the key variables that drive the business's value. He is not trying to find out if a stock is worth $150 when it's trading at $140. He is looking for a business that he calculates is worth roughly $200 when it is selling for $90. This is the zone of indifference. When the gap between price and value is that wide, precision becomes irrelevant. Who cares if the real value is $190 or $210? Who cares if your growth assumption is off by a percentage point? The conclusion is the same. It's incredibly cheap. You are operating in a zone where you can be wrong about many of the details and still be overwhelmingly right about the decision. This is the operational purpose of his most famous concept, the margin of safety. The margin of safety is not just a financial tool, it is a psychological tool. It is the buffer that allows you to be approximate. It is the shock absorber that protects you from the inherent uncertainty of the future. By demanding a massive discount, you are structurally insulating yourself from the need to be precise. You are building a system where you can win even if your calculations are sloppy. Let's examine this pillar through another iconic case study. Buffett's investment in the Washington Post Company in 1973. The market was in turmoil. The Nifty 50 bubble was bursting. The Watergate scandal, which the Post was instrumental in breaking, was in full swing, creating political uncertainty. The stock market was plunging, and shares of the Washington Post were getting crushed along with it. The entire company had a market capitalization of around $80 million. To the rest of Wall Street, it was just another falling stock in a sea of red. They were precisely focused on the short-term panic, the negative sentiment, the downward momentum. But Buffett, having passed the Post through his great filter, he understood the newspaper business, its competitive moat in a one-paper town, and the power of its brand, now applied his valuation framework of approximate rightness. He didn't build a complex DCF model. He did a simple, brutal, back-of-the-envelope calculation. He looked at the assets the company owned. He saw the Washington Post newspaper itself. He saw Newsweek magazine. He saw several television and radio stations in major markets. And he asked a simple question: what would a private, rational buyer pay for these assets if they were sold off individually? His conservative, approximate valuation of the television stations alone came out to be more than the $80 million market price for the entire company. In essence, he could buy the TV stations at a fair price and get the Washington Post newspaper, one of the most prestigious and powerful media assets in the world, and Newsweek magazine for free. Not just for a discount, for less than zero. This calculation did not require precision. It did not require a spreadsheet. It required a simple, powerful, qualitative insight, backed up by a dose of common sense and a profoundly conservative estimate. Was his valuation of the TV stations exactly right? Probably not. Was it approximately right? Absolutely. The margin of safety was so colossal, so absurdly large, that he was operating deep within the zone of indifference. Any error in his calculation would have been a rounding error. He didn't need to know the exact value of the Washington Post to know that getting it for free was a good deal. He began buying shares aggressively. That investment, which cost him around $10 million, would eventually become worth over $1 billion. It was a career-defining success, born not of a precise forecast, but of a simple observation of an overwhelming value discrepancy. The cognitive bias this pillar is designed to defeat is known as the illusion of validity, a term coined by Daniel Kahneman. It describes our tendency to believe that the more data we have and the more complex our analysis, the more accurate our conclusions will be. We are seduced by the appearance of rigor. A 50-page report feels more valid than a one-page memo. A formula with 10 variables feels more valid than one with 2. Buffett's approach is a direct assault on this bias. He understands that in complex systems like the stock market, adding more variables to your model often just adds more noise. It creates a false sense of confidence, not a better prediction. His method is to reduce the number of variables to the absolute minimum. What are the key assets? What is a conservative estimate of their worth? What is the whole thing selling for? If the gap between the two is not glaringly obvious, he moves on. He is not interested in intellectual puzzles that require a precise solution. He is interested in opportunities that scream at him. This is a profound form of intellectual discipline. It requires resisting the temptation to show off one's analytical skills. It requires being comfortable with a good enough answer. It requires understanding that in the game of investing, you don't get extra points for difficulty. The goal is not to solve the hardest problems. The goal is to find the easiest ones. By combining the great filter, which identifies simple situations, with the zone of indifference, which demands an obvious mispricing, Buffett creates a system that manufactures certainty, not the false certainty of a precise spreadsheet, but the true, deep conviction that comes from understanding the big picture so clearly that the details become irrelevant. And it is this deep conviction that powers the third and final pillar of the doctrine, the decisiveness engine. Pillar 3, the decisiveness engine. You have filtered the world down to a simple, understandable business. You have analyzed its value in an approximate way and have found that it is selling at a massive discount to your conservative estimate. The opportunity is not just good, it is overwhelmingly obvious. Now what? For most people, this is where the final demon of the precision trap emerges: analysis paralysis. The fear of being wrong, the desire for one more piece of information, the comfort of further study. These forces combine to create a state of perpetual inaction. The moment to act passes, the opportunity vanishes, and the beautiful analysis remains just that, an analysis. Buffett's operating system is designed for the exact opposite outcome. The entire purpose of the first two pillars, the ruthless filtering, the demand for a colossal margin of safety, is to generate the psychological firepower necessary to act with stunning speed, scale, and conviction. This is the decisiveness engine, because he only swings at the easy pitches, the ones right in his wheelhouse. When he decides to swing, he swings for the fences. This is the logic behind his famous 20-slot punch card analogy. Imagine you have a punch card with only 20 punches available for your entire investment life. With each investment you make, you use up a slot. This mental model forces you to treat every decision with extreme seriousness. You are not looking for 100 mediocre ideas. You are looking for a handful of truly magnificent ones. And when you find one that meets your rigorous, simplicity-based criteria, you don't just dip a toe in the water. You back up the truck. This is concentrated investing, and it is the natural, logical outcome of the Approximate Rightness Doctrine. Diversification, as it's commonly practiced by spreading money across dozens or hundreds of stocks, is, in Buffett's view, a protection against ignorance. It's for people who don't know what they're doing. If you have done the work, if you have filtered for simplicity and waited for an obvious mispricing, then concentrating your capital in your few best ideas is the most rational course of action. The decisiveness engine is not about being reckless. It is about having the courage of your conviction, a conviction that has been forged in the crucible of the first two pillars. It is a system designed to overcome the most common and destructive cognitive biases that plague investors in moments of opportunity: herd behavior, the fear of being different, and ambiguity aversion, the preference for known risks over unknown ones. When a true opportunity appears, it is often cloaked in fear, uncertainty, and bad news. This is precisely when most people are paralyzed. But Buffett's system, by focusing on the long-term, simple, and knowable fundamentals, allows him to see clarity in the midst of chaos. It allows him to be greedy when others are fearful. The ultimate case study of the decisiveness engine in action is the story of the American Express salad oil scandal of 1963. It is perhaps the single greatest example of Buffett's entire operating system at work. American Express was a wonderful, well-understood business. Its core operations were its travelers, checks, and credit card business. A business with a powerful moat based on trust and a global network. However, a division of American Express, a warehousing subsidiary, made a series of massive loans to a company called Allied Crude Vegetable Oil. The loans were secured by what was supposed to be barrels of salad oil stored in warehouses. But the charismatic founder of Allied, a man named Tino De Angelis, had perpetrated a massive fraud. Most of the barrels were filled with seawater, with only a thin layer of oil on top to fool the inspectors. When the fraud was discovered, Allied collapsed, and American Express was on the hook for millions of dollars in losses, a sum that threatened to wipe out a significant portion of its net worth. Wall Street panicked. The story was a nightmare of fraud and incompetence. The stock of American Express was cut in half. The consensus view, the precise view of the moment, was that the company was facing ruin. The fear was palpable. The uncertainty was total. This was not a situation that could be analyzed in a spreadsheet. The key variable was not a number. It was a psychological concept: trust. The entire American Express franchise was built on the promise that its travelers' checks were as good as gold. Would this scandal shatter that trust? Would customers and merchants abandon the system? This was the multi-million-dollar question, and it was not knowable with precision. While Wall Street was paralyzed, Buffett activated his system. First, the great filter. He already understood the core business of travelers, checks, and credit cards. It was simple, and its moat was powerful. The warehousing division was peripheral. The key question was simple: would the core business survive? Second, the zone of indifference. The stock had fallen so far that if the core business was even moderately damaged, the price was still attractive. If the core business was not damaged, the price was ridiculously, absurdly cheap. He was in a zone of massive asymmetry. The downside was limited. The upside was enormous. But he had to answer the qualitative question about trust. So he did what the analysts in their New York offices failed to do. He did the work. But his work was not building a financial model. His work was gathering approximate, real-world data. He went to restaurants and retail stores in his hometown of Omaha. He talked to the cashiers and managers. He observed customer behavior. Did they still accept American Express cards? Did they still trust the travelers, checks? He went to local banks and talked to the tellers. Were they still selling the travelers, checks? Was there any hesitation from customers? He even talked to competitors. The answer he got, again and again, was a resounding yes. The public associated the American Express brand with its core products, not with its obscure warehousing subsidiary. The trust was intact. This was not precise data. It was anecdotal, it was fuzzy. But it was profoundly insightful. It was approximately right. Armed with this knowledge, he activated the decisiveness engine. He took 40% of his investment partnership's entire capital, a colossal, career-risking bet, and plowed it into American Express stock. He backed up the truck. The result was a spectacular success. As the panic subsided and the fundamental strength of the core business reasserted itself, the stock soared, and Buffett's partnership made a fortune. He had been able to act with supreme conviction in the face of total panic because his operating system was not designed to predict the future with precision. It was designed to identify moments of extreme mispricing in simple, understandable situations, and to provide the psychological framework to act on them decisively. That is the power of the complete system. The great filter provides the clarity, the zone of indifference provides the conviction, and the decisiveness engine provides the action. It is a seamless cognitive assembly line for transforming uncertainty into wealth. So how do we, who are not Warren Buffett, begin to uninstall the defective operating system of false precision and install this superior one? How do we apply the approximate rightness doctrine in our own lives, our own careers, our own investments? It begins not with a new tool, but with a new mindset. It is a process of deprogramming. It requires a conscious and deliberate war against the psychological biases that chain us to the pursuit of the trivial. Here is a practical blueprint for installing this three-pillar system in your own mind. First, you must build your own great filter. This means becoming a ruthless curator of your own attention. For every problem, every opportunity, every idea that crosses your desk, your first question must not be, "How do I solve this?" but "Is this one of the few things I can truly understand and that truly matters?" You must become comfortable with having a too hard pile, and it must be massive. Practice the art of saying, "I don't know," or "I don't have an opinion on that." In your career, this means identifying the 2 or 3 key activities that generate 80% of the value and focusing your energy exclusively on them while ruthlessly culling the rest. It means having the courage to tell your boss, "This new initiative is too complex, and its chances of success are unknowable. We should not do it," instead of generating a 50-page report that gives the illusion of diligence. In your investing, it means making a list of industries you can explain to a 10-year-old and ignoring everything else, no matter how exciting the story. It is an act of intellectual humility, and it is the foundation of all wisdom. Second, you must train your mind to operate in the zone of indifference. This means changing your relationship with numbers. Stop seeking the precise answer. Start seeking the overwhelming conclusion. In business, when analyzing a potential project, don't build a spreadsheet to see if the internal rate of return is 15.2% or 15.8%. Build a simple model with conservative assumptions to see if the return is obviously, overwhelmingly north of your hurdle rate. If you have to sharpen your pencil to make the numbers work, the idea is no good. The answer should jump off the page. In investing, stop trying to calculate if a stock is 10% undervalued. Look for situations where it appears to be 50% undervalued. Learn to do back-of-the-envelope valuations that focus only on the most important variables. Can you, in 5 minutes with a pen and a napkin, make a compelling case that this asset is dramatically mispriced? If you can't, move on. This is not about being lazy. It is about being efficient. It is about reserving your finite mental energy for the truly obvious opportunities. Third, you must deliberately construct your own decisiveness engine. This is built on preparation and courage. It means doing the work before the opportunity arrives. You build your great filter and your zone of indifference during times of calm, so that when a moment of crisis or opportunity arrives, you are psychologically prepared to act against the herd. When the market is panicking, you should be the one with a short list of pre-vetted wonderful businesses that you understand deeply. Your only question should be, has the price fallen into my zone of indifference? If the answer is yes, you must have the courage to act. To overcome analysis paralysis, use a simple mental device. Ask yourself, If I had a punch card with only 20 slots for the rest of my life, would this decision be worthy of a punch? This forces a higher standard. It kills mediocrity. It elevates decision-making from a daily chore to a sacred act. The installation of this operating system is a lifelong project. It requires a constant vigilance against the pull of complexity, ego, and institutional pressure. But the rewards are immense. It is a path not just to better financial outcomes, but to a state of profound mental clarity. You waste less time on the irrelevant. You suffer less from the anxiety of the unknowable. You develop a deep, quiet confidence in your ability to navigate a chaotic world, not by knowing everything, but by understanding a few things profoundly. You stop trying to be precisely wrong and start learning the quiet, world-changing power of being approximately right. This entire operating system, this three-pillared machine for generating rational, wealth-creating decisions, is a powerful weapon. The great filter, the zone of indifference, and the decisiveness engine. Together, they form a cognitive fortress against the madness of crowds and the folly of the ego. But it has a failsafe, a final check, a master algorithm that governs its use. What stops a focus on the big picture from becoming a reckless disregard for critical details? What prevents an approximately right decision from becoming a recklessly sloppy, one that ignores catastrophic ethical risks? It is the ultimate governor on Buffett's cognitive engine, a system that ensures that even a financially brilliant, approximately right decision is never, ever made if it compromises the one asset he values above all capital, above all companies, above all else, his reputation, and the reputation of Berkshire Hathaway. This asset is so powerful that it acts as its own moat, attracting capital, talent, and opportunity automatically, without effort. To protect this fortress, his most valuable and irreplaceable asset, he runs every potential action, every decision, through one final, ruthless mental model. He calls it the newspaper test. It is the framework that builds the ultimate competitive advantage, an indestructible moat of trust that makes wealth generation almost inevitable. It is the final and most powerful layer of the Buffett operating system. And if you are ready to install it, you must watch the documentary appearing on your screen right now. Click it and complete the installation.